Welcome to Technical Tuesday. This is Fed Razak, Senior Trading Strategist here at CMTrading. Today, I'm going to break down the five-part process in executing a trade. But before we start, make sure to smash the like button, share, and do subscribe, especially if you find value in this presentation. Okay, so here it goes. Five-part process to executing a trade. But here is a prelude to that. So there are two parts to the markets. There's the trader, and there's the market. Two variables, right? The market does what the market does. And as a trader, we're taught to use historical data to anticipate future moves in the market. So wait a second. How is that possible? Because let's say I'm looking at a chart of a 5-year chart, maybe 10-year chart. Let's take it even further, 50-year chart of something. And I see things are hitting certain levels and there's certain support or resistance. And I'm supposed to draw conclusions to it based on people that are no longer alive, who traded 50 years ago, or 10 years ago, or 15 years ago. How is that possible? At any given moment in the market, it's a unique circumstance. There are different traders. There's different amount of money that is being put into that particular asset. There's different times in the day. There's different circumstances. The climate has changed. How is that possible? How are you using historical data to anticipate future results? Now, here's the thing. This is the one element that stays consistent. The trader. The trader needs to stay consistent, because if you have inconsistency in an inconsistent environment, then you're never going to have consistency. I know that sounds a little bit twisted, but here it is. To be a successful trader just means that you need to be consistent. You need to execute your trades consistently. Does that mean that you're making money on every single trade? No, it doesn't. But you're being successful by executing your consistent trading ideas. Now, look at this, okay? Over a 15 to 20 year period, okay? If you look over Warren Buffett or any one of the major, fund managers out there, Ray Dalio, Warren Buffett, Peter Lynch, Jim Simmons, they have a certain criteria to why they enter the market. It's called a trading edge. Each one has developed their own trading edge. So what is a trading edge? A trading edge is a certain criteria of why you enter or exit the market and how you execute those trades. And that is the process of how you execute or trade your edge, okay? Now, each one of them are very different. Warren Buffett is very different than Jim Simmons. Jim Simmons is very different than Peter Lynch, but they've all been successful by using their criteria. So I'm going to just digress on Warren Buffett for a second, because Warren Buffett has stood the test of time like no one else, okay? He has a set of 15 rules of why he enters or exits a particular investment. Now, if you look over his investment portfolio over the past 30 years, and I have been privy to really see it over the past 30 years, much of it, okay, only until recently, maybe 4 or 5 years ago, did he enter anything having to do with high tech. I believe he bought Apple. But before that, nothing had to do with any high tech company. No Apple, no eBay, no AOL, no internet boom stocks, none of that. He traded in completely unrelated companies that satisfied his criteria for investing in them. And that's what I want to do right now. I want to sit down with you here and discuss how to go through the process of executing and trading your edge. So number one, you got to pick a market. It has to have liquidity. It has to have volume. It has to have those two elements to be a market, right? Without liquidity, without volume, without participants, without price fluctuations, it's really irrelevant, right? You can't trade something that's not trading, right? You need liquidity, you need someone to sell to, you need someone to buy from, and that's that. Then you choose to set variables that define your edge. Now, like I said before, Jim Simmons was very different than Warren Buffett. Peter Lynch is very different than Ray Dalio. They all had their set of criteria why they enter the market. Now, you have to do that work yourself. Now, there's a lot of books up there about technical analysis, and we've even spoken about it several times, but you choose 3 or 4 that you apply to a certain market on a consistent basis. You then need to choose an entry price, a price that's going to satisfy why you're entering that particular market. Now, that price doesn't have to be perfect. It's not going to be perfect, and you have to pre-accept that. And number 4, you have to have an exit price, both on making the profit or not, because sometimes, like I said before, you're in an inconsistent environment. So if you're trading a particular edge, you're trading a particular strategy, and it's not working out, which often does happen, you have an exit strategy. You're not going to just stick to it. You're not going to live in this fantasy land, oh, it's going to come back. You've pre-accepted it before you've entered the market so that you could exit the market at that pre-described price, so that you're controlling yourself. It's like putting a seatbelt when you're driving. And number 5, and this is probably the most important one, it's got to put a time frame to it. It can't just be forever. It can't just be 2 days. It can't just be 3 days. It needs to really satisfy all 3 of these criteria, the first 3, in order to satisfy the last one. Because if it's not doing anything, or it's not going the way you anticipated it, move on to the next trade. That's it. Follow these 5 steps, and you'll be successful on every single trade. Thank you for joining us for this Technical Tuesdays. We'll see you here next week.